isn't necessarily what's going to happen.
But Michael, are the rate moves and the traders, are they data dependent? I'm thinking about what Liz Ann Saunders of Schwab said to us yesterday, and she's like, stop focusing on the debate about what's the Fed going to do, when is it going to cut rates, how many rates, like just that's not what investors care about. Like, and she was tying what's going on in equity markets is based on what's going on in the rates markets. The rates market, are they taking their cues? I mean, they do take their cues from Jay Powell. They also, though, do from data points, right? Like,
yes, they do.
Help us understand.
But they do. But you've got to remember, there's different types of investors. I mean, the people who are trading IIS swaps, and sort of trading between whether there's going to be a November cut, December cut, or maybe saying, actually, November's too close to the election, so maybe it's going to be a September cut, and they'll jump back in there if they get any kind of relief from the data side. They're the short-term momentum players. Longer-term investors who've been telling us for weeks, God, it's so nice to see yields finally getting into that 4.5%-5% zip code. We didn't have that since 2007. And so their advice is, look, you've got to start strategically allocating more and more money and scale into the bond market as it sells off. The other point to make about all this, of course, is that the market priced in a lot of rate cuts at the start of this year, in part because Powell made the famous pivot in December. Now, as the market takes that out, you're tightening financial conditions. If you keep pushing yields higher, you're going to keep tightening financial conditions. And therefore, things will start to slow down again. And then the market will go back. It's kind of like a washing machine cycle.
But that's kind of what we saw in like August, September, October, when we saw yields move higher.
Yes. So at the moment, the Treasury index is on course to have its worst month since last February. And in fact, it's not that far away from actually being the worst month since the dark months of 2022, when things were really getting rocky. So that shock is coming through. Equities will probably take more of a hit too if yields keep on going up. Because ultimately, can this economy live with real yields going towards 250? I mean, that is debatable, but I think at the end of the day, as rates keep going, that's going to actually help slow things down. So ultimately, you will get some kind of cuts from the Fed, I would think, if this is the direction of travel.
What about the argument that, well, wait a minute, some investors are actually feeling, wealthier, that they've put money in, whether it's money markets or so on and so forth, and they're getting some decent returns. Or you look at some of these mega cap tech companies who've got so much cash on their balance sheet, and they're actually making money. We talked with our Bloomberg intelligence team, and they said they're actually making some real money on all of this. How does that impact things?
Well, there's a theory.
In terms of the economic impact and a slowdown.
There's a theory that the Fed's high rates are actually goosing the economy, but nobody really at the Fed would believe that.
All right, that's a
the wealth
smackdown
effect
for me.
is not big enough. And the fact is that people who have enough money to be really making money in the markets aren't going to just start spending more because the markets are going up. They'll just keep spending as they do. So I don't think there's a lot to that.
What do you say to Michael saying real yields at 250? Can the economy live with that?
It looks like it. I mean, that's the thing that the Fed is saying at this point is we don't have to, because we have real yields at that level, and we have very low unemployment, and we have reasonably strong growth. Inflation's a bit of a problem, but we'll see how that goes over the next couple of months. So we don't need to react at this point. And when you go back in history and you look at what happened after previous recessions when the Fed started raising rates, before we got into the great financial crisis and went to zero, this is not an unusual rate level. 5.5 is maybe a little bit higher than you would have seen, but you're looking at 4 to 5% as a kind of a normal rate. Now, it's been 20-some years since we've been there, so people aren't used to that, but the economy functioned with that.
Is that the feeling that you're getting right now talking to bond investors, that this level of rates is the new normal?
Yeah, they think it's a return to what we had before the financial crisis. I mean, the financial crisis was the biggest economic shock since the Great Depression. You had the biggest collapse of financial markets and of the banks since the Depression era. I mean, it came, 10 years after they dismantled Glass-Steagall? So, again, it takes a long time to recover from those kind of huge balance sheet shocks, particularly when it's overlaid with a massive housing bubble bursting. So you had both households and banks taking a massive hit. It took a decade to get through. And then you get COVID, which is suddenly just is a massive infusion of cash into the broad economy. And so we now have, inflation picking up, the Fed unable to be yet to be confident enough that it can start to ease back on those brakes and start cutting rates again, because they don't have the confidence that inflation is truly under control. And it is a tricky period for the Fed, because whenever you do see a pickup in inflation, yes, it will come down, but if it remains elevated, that means the economy is vulnerable to another inflationary shock, which just kicks it back up into gear. But I think in general, bond investors like what they're seeing. They do think, yes, there's potential for rates to go a bit higher from here, but in general, they think we're pretty much near the top. But it's very difficult to pick a top. So this is why a lot of the longer-term investors are just scaling into the market. And in particular, though, they are not comfortable about debt beyond 10 years. And that gets back to the spending that's going on in Washington. It gets back to the fact that whilst the tax receipts have come in strong this year, that will kind of push supply, eases the pressure on supply concerns. Next year and beyond, particularly given however the election shakes out, you're going to have another round of supply and more pressure coming through. And the one thing I will say, if I look at the 10-year and the 30-year, they really haven't truly come back to where we were before the financial crisis. Because if you look at the very geeky bond model that says, what is the risk premium? It's only still around 0 for 10 years. That, to me, is a problem, because you need to have a positive risk premium. Partly that will come about if the curve steepens. But if you talk to investors, that's why they're a bit reticent about 10-year and longer debt.
I do wonder, we've had a lot of guests, I feel like, who've come on and just reminded us about the importance of U.S. government debt and managing it and servicing it, and the additional issuance that will be needed. Mike, go back, right? How many years that we've talked about this so much in the past, and then it kind of went away, but concerns about the cost of the ballooning government debt and servicing that. How do you think about that in terms of the economic impact?
Well, the way the Fed looks at it is, if it has an impact on the economy, they might have to react, but they really can't do a whole lot, because the government, the fiscal side is not their area. We have been talking about the problems of high debt forever, and we've never hit the spot where it really affects the economy. Now, economic theory tells you that it will, but we don't know where that is, and we don't know how it's going to play out. This is the biggest economy the world has ever seen, and we have our own printing press, so there are ways you could deal with it, but you don't want inflation to break out because of that. So there isn't much the Fed can really do. They don't have a context for it, because we haven't had the problem. They just think at some point it's unsustainable. Where that point is, we don't know.
That's why I kind of bring it up. I feel like we used to talk about it and then it went away. Final thoughts here, Michael? Just got about 10, 15 seconds.
I would think that Powell speaking next week probably is more important than tomorrow's data. And then I think the jobs number next week, if we still see a strong labor market that's not softening, I think the market could probably well take out rate cuts for this year then.
Interesting.
Throw in refunding on Wednesday.
And then you got the refunding, but again, the tax receipts are good.
Hey. All right.
It's a trader's market.
Our own Michael McKee and Michael McKenzie, great duo. Still to come, the year of efficiency, come back, or so it seems to be the call from investors who are taking Meta platform shares down today. More in a moment.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars. has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, Mike McKee says it's not stagflation, but traders, they're still worried about the data we got this morning. The GDP report showing slowing economy and higher inflation. Toss into the mix some of disappointing earnings. It's a recipe for the stock sell-off and for yields to push higher. Traders also saying a rate cut from the Fed probably not going to happen until later this year, November, maybe December. As you said, Meta Platforms, worst performing stock right now in the S&P 500. Those shares down.
January, February.
Well, no, the betting is, it was
I know.
December. Now it's kind of like pulled back to November.
Just interesting.
Anyway, after the close, we're going to hear from the next two members of the cohort we know as the Magnificent Seven. That would be Microsoft and Google's parent Alphabet. Anyway, again, I'll say it again. We're off the worst levels of the session. S&P 500 down just 0.4% right now, 20 points lower. We're at 5,051. The Dow Jones Industrial Average, 348 points lower. That's down 0.9%. And the NASDAQ Composite right now, 93 points lower. That is down 0.6%. Real quick, those yields, the more policy reactive 2-year yield. Let's just call it 5%. We'll round it up. Up 6 basis points the 2-year.
You can't do that. You can't do that.
I just did it.
You got to be exact.
How many decimal points you want me to go out?
Just telling you. Those decimal points are money.
No, we round up. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. You thought this was going to be a solo act?
Yeah, no, it's not going to be. Sorry. I feel like I'm around my dinner table growing up. This is kind of what we did. All right, John Tucker, thank you so much.
Why did Tim bring any cherubs in with him? It is bring you.
Because they're little critters.
Well, after I got home last night, I realized I had 2 kids. And
whoa, honey, where'd that one come from?
It is Bring Your Child to Work Day, but
children.
You kind of want older kids to bring in, I think. You want to wait a few years.
I think your son would have been great.
Yeah,
right.
I wouldn't be here if you were here today. I'd be running around.
2 kids.
Yes, 2 kids. That's right.
All right, if you missed it, you got to go back to yesterday's show podcast, download it. All right, let's get to Meta Platforms because shares of Meta are tanking today, although down 16% at their lows, just right now down about 10%. And so this has kind of been at its lows today, the biggest move since October of 2022. This as Mark Zuckerberg asks investors for patience again as Meta gets ready to spend billions of dollars more than expected this year, fueled by investments in AI. That spending forecast coupled with slower sales growth than anticipated, really safe to say, freaked out investors last night when they reported, and then, of course, in today's trade.
Well, back with us right now, the guy who led us into the report yesterday, also out of the report yesterday with the expert analysis. He's back with us right now. Of course, that's Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh here in the studio. So you were on with us right as the numbers came down, the amped up spending forecast. You called it right when you saw that number. As you've had a few hours to dig into it, to listen to the call, is today's sell-off justified given what we heard from Mark Zuckerberg on the call?
I mean, the earnings call actually was quite good in the sense that there are a lot of details around AI which show that Meta is one of the top companies when it comes to generative AI. I would say in the top 3. And I think that's music to investors. So if they were saying we are ramping up CapEx to invest in generative AI, by offsetting the losses that we are, and we'll curtail our spend on Reality Labs, I think the stock would have been up.
Who are the other two? Are they Alphabet and Microsoft?
Alphabet and Microsoft
are the
correct.
other two
Yes.
companies. Okay, where in Meta Platforms you'd say would be number 3?
Because they have their own large language model, they have the infrastructure, the GPUs that you need to train those models, and they're actually deploying it on their family of apps. The thing we were discussing yesterday, Meta AI, it's a contender to gain share in search, and that could be a big product in itself. So why get distracted by Reality Labs, AR, VR? I mean, look, it's a long-term bet. It's a pet peeve for Mark Zuckerberg where he feels very passionately that will be a big category. I just think they're not sharing enough details with the investors to convince them that this is a bet worthwhile, spending $50 billion on. Imagine if Meta was making an acquisition worth $50 billion and they had nothing to show for it. How would the investors react on that?
Not so great.
Think about
it. Hey, having said that, I feel like when we talk about artificial intelligence, you guys, the Bloomberg Intelligence team, did a great thing on Gen AI and just trying to understand kind of where we're all going and the players in it. But having said that, I feel like our conversations so often, Mandeep, have been about Microsoft and what they're doing, their big investment that awakened the world, if you will. Meta, like, how is it that they got to be so quickly, it feels like, such a leader in AI?
Well, so you bring up a great point. Actually, so all the CapEx they were making on Reality Labs, some portion of it actually did play a role in them getting to where they are in generative AI. So not all of them, all of the investment they made was bad CapEx.
Yeah.
It's just, I think with generative AI, what they found is they have the data, the proprietary data from the social networks that they can use to train their own generative AI algorithm. The reason why Alphabet is in that top 3 is because they have the data, search, maps, and we are going to see that tonight, how well they end up doing.
Well, this is what we always talk about, right? That the machine learning, it only becomes smarter if you have all the access to the data points. Is that?
And these companies have data at scale.
Yeah.
So Microsoft, I mean, it doesn't have its own data, but it partnered with OpenAI that had the data. So that's why all these companies have that common denominator when it comes to data.
What's the data that Meta Platforms actually has? If we think about this from the perspective of search, and I think everyone's familiar with the way that Google search works and the way that Google's experimenting with AI in its search results, what's the data that Meta Platforms is actually tapping into to deliver the answers that people are looking for? Because frankly, I'm not that interested in, I don't go to these platforms to look to answers the same way I would using Alphabet's Google.
Well, so think of how LLMs are trained. They're trained on open web data where there are real conversations. Like Reddit is the most commonly used data set across all the large language models. The reason why that data is so good for training is because it's got real conversations that the model or the algorithm can learn from. Similarly, with Meta, they've got images, they've got text data, they've got videos. So all this data in aggregate has a lot of knowledge that it can be used for training their own large language model in addition to the open web data. And look, they are trying to commercialize it. They're trying to develop an ecosystem around it where the chatbot can be powered by Meta's large language model. So all this is going in the right direction. They're deploying it within their apps. Like right now, you can go to Meta AI within WhatsApp, and you can have a conversation like with any other chatbot, like Google Search. And so there's so much surface they can monetize. Why get distracted by Reality Labs?
So, okay, so last quarter, look to the current quarter. If they come out and we do second quarter earnings and they say, what, fill in the blank, then would you be worried?
No, and they
Is there
have
something that they could say, though, when they report the next time around?
So you go back to third quarter of 2022.
Yeah.
They did the same. They had CapEx and OpEx growth way above of top line growth, and that spooked the investors. That lasted 2 quarters, and then they walked back. They walked back their CapEx guide. They walked back their OpEx guide. I imagine they gave a pretty wide range for CapEx. Well, they'll say we'll be at the lower end of the CapEx and everything is great.
Everything will be wonderful.
So you're essentially just giving themselves some room right now.
I think so.
Or testing the waters, perhaps?
Like the press release had, it's a multi-year investment cycle. Nobody wants to hear that you're going to keep losing $20 billion every year.
When you're up 40% going into the print for the year, and when you're up, three-digit gains last year,
right?
Then you have that wiggle room.
Well, yeah, I mean, the stock can go down.
Stock's still up 20% this year.
Right, but investors were like, wait a minute, because we gave you, look at what we did.
I mean, you got to earn the trust of the long-term shareholders. Remember, when they had an 80% drawdown, a lot of the long-term shareholders just gave up. And now they acquired these new shareholders. Last quarter, they announced a good capital allocation strategy, buybacks, dividend. That's great. But now suddenly it's like, we are in an investment mode, and guess what? We're going to spend a lot.
We saved 2.5 minutes for Google, Alphabet. So they're just up about almost 12% this year. So give us kind of the key things. Is Gen AI once again a big factor in this release?
Yeah, I mean, search is what drives all their profit. You don't want that search number to miss because cloud and YouTube are great. Everyone likes the
NYMEX diesel May futures settle at $2.55 a gallon. NYMEX gasoline May futures settle at $2.75 a gallon. NYMEX WTI June futures settle at $83.57 a barrel. That's up 76 cents or 0.92%. And NYMEX natural gas May futures settle at $1.63.
To take share from Google because everyone is like trained on Google.
But are they selling ads against that at this point?
It doesn't matter. For an incumbent like them, they just need to make sure they don't end up losing that engagement. They will be able to show you more ads. I mean, right now, in its current form, even before generative AI came to the scene, they only monetize 50% of their ads. 50% of the ads didn't have any, it showed blue links, but there were no ads shown because that's how they kept their users engaged. They only showed ads when you have a bid for the keyword, and that's when they show ads.
So that engagement more important, like I think about the partnerships between Apple and Alphabet, like those things are more important to Alphabet and their bottom line ultimately?
If Apple says we are using generative AI to come up with their own search, that's a big threat to Google because then it loses all the iOS ecosystem users and it's not the default anymore. That's a big threat.
What are you looking for very briefly from YouTube and YouTube Shorts?
YouTube, I mean, the expectations are quite low. I think 15% growth when Meta did 27% growth. There's no reason why YouTube ads shouldn't grow more than 20%. And the YouTube subscriptions should also grow above 20% because that's been doing very well over the last 2 quarters.
These are the paid subscriptions to YouTube.
Paid subscriptions.
To remove ads.
Correct.
Okay.
Yeah. And so
what about Shorts?
Shorts is kind of embedded in that ad revenue because they don't have a subscription, but it should, like I said, with all the kind of noise around TikTok, it should help YouTube and Instagram. And Instagram, it did. I think with Meta's this quarter results, it was pretty strong.
Search and engagement. AI, got it. There it is. Our marching orders. Mandeep, thank you so much. So appreciate it. Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh with the latest on Meta, as well as what to look out for when it comes to Alphabet. Hey, coming up, we've got Airbus out with earnings about 3 hours ago. We're going to hear from the Airbus CEO.
Yeah, looking forward to that, though. First, in the meantime, a check on the latest world and national news. We got Amy Morris in the Bloomberg 99.1 News in Washington, D.C. Hey, Amy.
Hi, Tim. The Supreme Court heard arguments over whether Donald Trump should be immune from prosecution for actions he took during his time as president. Justice Sonia Sotomayor asked Trump lawyer John Sauer about their end goal with this case.
This is what you're asking us to say, which is that a president is entitled not to make a mistake, but more than that, a president is entitled for total personal gain to use the trappings of his office. That's what you're trying to get us to hold, without facing criminal liability.
Justice Sotomayor. Under questioning from Justice Amy Coney Barrett, Sauer acknowledged that some acts alleged in the indictment were private acts. Those arguments lasted more than 2 hours and 40 minutes. A crucial witness in Donald Trump's criminal trial is describing his role in the central part of the case against the former president. David Pecker, the former publisher of the National Enquirer, is testifying for a third day about what prosecutors say was a 3-man conspiracy to aid Trump's bid for the presidency. And we can tell you the FCC has now restored net neutrality rules that prevent broadband internet providers from favoring some sites and apps over others. The move effectively reinstates a net neutrality order that the Commission first issued in 2015. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello! You guys love these meet and greet things.
Me too! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
DOJ or other authorities.
Could face bigger challenges. Listens next.
It was going to keep Rain World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now. News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Get your income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. Kind of a bad combination today for the risk assets. The economy losing momentum in the first quarter and inflation accelerated. This is a kind of a troubling performance that we saw with the GDP. It expanded at a 1.6% pace. That is actually the slowest almost 2 years. And then inflation, that was most notable in the services. The major stock averages sold off as a result of that, and yields pushed higher. You have Meta Platforms' worst performing stock right now, the S&P 500. That is down just about 11%, 11.3%. Caterpillar shares, they're weighing on the Dow Jones Industrial Average. They delivered a disappointing second quarter sales view. And those shares, Caterpillar, down right now 6.7%. Overall, the S&P 500, 36 points lower. That's down 0.7%. So that's much better than we saw earlier, pairing some of those earlier losses. Right now at 5,036 on the index. The Dow Jones Industrial Average down 452 points. That's a decline of 1.2%. And the NASDAQ Composite Index is down 145 points. That is a decline of about 0.9%. Back to those yields, the two-year yield up 6 basis points at 4.99%. The 10-year is up 6 basis points. That is at 470. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Tim and Carol.
Great, so much. Thank you so much, John Tucker. Well, we are in the midst of earnings season, and Airbus out with their earnings results today. The European plane maker benefiting from trouble at its arch rival, of course, the other big player in the industry. We are talking about Boeing, which, as you all know, has been mired in crisis following a near catastrophic accident early in January. Airbus has quietly pressed its advantage, picking off orders from Boeing loyalists that have been clamoring for more planes.
As for the earnings update, Airbus will further increase production of its advanced A350 wide-body jet as the plane maker benefits from surging demand for the long-distance travel and the crisis engulfing its arch rival Boeing. Earnings before interest and tax missed analysts' forecasts amid higher costs. Airbus continuing to struggle with a supply chain that remains constrained. Shares of Airbus ADRs that trade in the U.S., Carol, down right now by about 4%.
Yeah, we've seen them. I mean, the overall market here in the United States has been much lower. We've seen bounces off the lows. Earlier in the session, shares of the ADRs of Airbus down about 5.6%. But as we said, bouncing off those lows with about a 4% decline. But lots of things we want to know. Certainly in a year that we have talked so much about the woes over at Boeing and what it means for Airbus specifically, as we've seen some of the airline carriers, much known to those of us here in the U.S. who have been thinking about, okay, where do I buy my planes in the future?
As a reminder, though, for everyone, the customers of these companies cannot just simply pick up the phone and switch their orders from Boeing to Airbus. A lot of these planes are ordered for years to come. They're accounted for years to come. Plus, the fleets are have the pilots that are trained on these certain pieces of equipment. They have maintenance crews that are meant for that. They have airports and gates that are meant for those things. You can't just switch these things out.
Right. This is something we've talked about with our George Ferguson of our Bloomberg Intelligence team and the rest who cover certainly these two big players. Right now, though, let's get more on Airbus's results and the outlook. We head to London and Bloomberg's Guy Johnson talking with Airbus CEO Guillaume Ferré. Over to you.
Carl, thank you very much indeed. You guys have laid it out brilliantly in terms of what we're facing here. As you say, Boeing taking the spotlight for all the wrong reason, Airbus cracking on and delivering planes to its customers. But the Q1 numbers look a little light on where I think analysts were expecting them to be. So I think investors this evening...
Brent crude futures settle at $89.01 a barrel.
Are so high at Airbus right now.
That's up 99 cents or 1.12%.
Carrying the kind of levels of inventory that nobody thought they really would be having to do so at this point. So let's try and find out some of the answers to those questions. Guillaume Faury is the CEO of Airbus and joins us right now. Guillaume, welcome to the program. Thanks for taking the time to join us. Let's talk a little bit about where we are with these Q1 numbers. As I say, cash flow looks a little light. We're wondering why you're carrying so much inventory. We're wondering why costs are so high. Are these one-offs? Are these just associated with the first quarter, or are these going to be numbers that are going to linger into the latter part of the year?
Hello, Guy. Good to see you. We've indeed released our Q1 numbers. We've delivered 142 commercial airplanes in the quarter, which is 12% higher than last year. So in terms of production deliveries, we feel we're on track, and that's very important. The quarter is indeed a bit soft, but it's again on track with our expectations to keep our guidance unchanged for the year. And we are building indeed a lot of inventory. We're operating in a complex and difficult supply chain environment, and we want to make sure that we have the resources, that we have the hardware, the equipment, and everything we need to keep ramping up in a year that will be backloaded, a bit like what it was last year.
Okay, so we're going to see more aircraft deliveries in the back half of the year. There's a line, Guillaume, that stands out from the press statement, and it's right at the top, and I think it's worth repeating to the audience. We delivered first quarter 2024 results against a backdrop of an operating environment that shows no signs of improvement. Geopolitical and supply chain tensions continue. Guillaume, why are you still dealing with supply chain issues? Many other industries face these kinds of problems during the pandemic, but they are long in the rearview mirror. Why is aerospace still struggling with these issues? Why are they so hard to fix? Why is the supply chain not being sorted out more quickly?
Yeah, Guy, it's a very important question. Actually, we are in a long-term industry. We employ people which are highly skilled and qualified, and a significant number of the workforce of the people left the companies in the supply chain at Airbus with other companies during the pandemic. So we are rehiring people, but it takes a lot of time to onboard them, to train them, to give them the qualifications, and to have them at full speed. And this is a bit across the supply chain. But there is another reason why we are in this difficult environment, and we will remain in a challenged supply environment, is because we're ramping up at full steam, at the maximum speed we reasonably can. And this will continue till we reach the rate 75 on the A320, which is expected in 2026. And you see that now we decide to continue to ramp up on the A350 beyond the rate 10 that was already announced, up to rate 12 in 2028. So we are victims sort of our own success. We have a lot of demand. The demand is higher than the supply, and this will continue to stretch the supply chain for some years.
The supply chain, as you say, is stretched. You are having to support this supply chain in many different ways, putting staff into their factories, supplying or helping out with financing, or at least telling the banks how the order book is going to look. Guillaume, are you getting to the point, though, with the supply chain where you're going to have to start taking bits of it over? You're going to have to start taking equity stakes in order to make sure that you can deliver on that ramp up in production that you're talking about and supply the aircraft that you have promised?
Actually, we count on the financial institutions to do the financing, to play their role. We are the end customer, we are the OEM, and the support we're providing to our suppliers is mostly in the form of technical support, sending our own teams on site, understanding the way the ramp-up plans are secured, if not working together to adapt and anticipate as much as we can. And we have some suppliers which are in real difficulties that have to do transfer of work. And in that case, it's a lot about anticipating, making sure that the execution is okay.
Noting Brent crude futures rise by more than $1 per barrel to $89.08 a barrel in post-settlement trade.
People, skill, know-how, competencies, and money to the supply chain.
Do you think, though, that you are going to have to go further than that? Could you be buying some of these companies to make sure that your supply chain is secure?
There are few cases where we have to take these kind of decisions. We like to be making those decisions when there is not only a defensive approach to a difficult situation to manage, but also a strategic intent, a strategic relevance to the case. And you might remember that we acquired 2 years ago, together with Safran, a company called Aubert et Duval, because that was making a lot of sense for us strategically on those special alloys for the long-term future. There are other ways of dealing with the situation, with national associations that go deep into the supply chain, with mediation and with brokering relationship between suppliers and financial institutions, as I said earlier. That's mostly what we do.
Yep. Okay, we've seen what happens when the supply chain can cause problems. Let's talk a little bit about what's happening with Spirit right now. Boeing, Dave Calhoun, obviously in the process of retaking over that business in Wichita. He says, though, that he will not be held hostage by the Airbus portion of Spirit. He wants that deal to go ahead and go ahead quickly. He sounds like he's saying that he basically wants that whole transaction to go at his pace. Are you comfortable with going at his pace?
Well, I fully respect what Boeing is trying to achieve with Spirit. As you know, we are at Airbus with a very vast majority of our aerostructures, of our fuselage coming from make, from core business and companies that we own. So we respect what they try to achieve by buying back Spirit. Now, there are some important work packages of Airbus planes that are with Spirit, mainly the A350 Section 15 and the A220 wings. And we want just to be clear on the fact that we don't want those work packages to be with our main and direct competitor. So we need to find a way forward that works for both parties, but we don't want to take anybody hostage. We just want to do what is right for Airbus.
When do you think, therefore, you'll be in a position to make all that happen? Airbus obviously needs this to work, but does it need it to work quickly?
Against the backdrop of this change of situation with the recent announcement that Boeing wants to acquire Spirit, we have started to work. We have engaged with Spirit, but I can't be precise on the time it will take. We have just started the discussion. We are engaging in a very constructive and active manner, obviously, but it's premature to give a timeline.
Okay, so when Dave Calhoun talks about maybe the end of this quarter, that doesn't sound familiar to you?
Well, there are different ways of dealing with the situation. As I said, we are very constructive and we don't want to take anybody hostage, but we want our interest, rights, and the discussion with Spirit to be smooth and efficient, and we are engaging for that.
You said earlier this week, Guillaume, that you are turning customers away when it comes to the narrow bodies. You are sold out many years ahead. How many customers are you turning away at the moment? How many people are coming to you and saying, can you sell us some aeroplanes? The guys were talking about this just a moment ago. You can't just pick up the phone and kind of order an Airbus. There's a long timeline here. But how many customers are ringing you up saying, have you got any slots? How many people are you having to turn away right now?
Well, I don't like the idea of turning away. We are always welcoming customers reaching out to us. Now, the facts are what they are. We have no available slot for the A320 family now before 2030, and that's the reality. So we have to face that reality, and there is indeed in the market a shortage of plane. There is more demand than supply. We're trying to do our very, very best, but we are with an order book that is what it is. It's a very big one. And for new customers coming, they have to understand, they have to respect the fact that available slots now for the A320 family are in the next decade.
How far into the next? How far out, assuming you get to your 75 per month level, how far out are you sold out?
We have, as I said, available slots in 2030 onwards.
Okay, 2030 onwards. Let's talk about the wide-body market. The wide-body market has come back and looks pretty healthy right now. You've announced that you are, as we were discussing earlier, going to be ramping up your production of the A350. But it's not going to be until 2028. Indigo from India earlier today announcing a fairly substantial order. You say that the supply chain is in a position to make that ramp. Why are you waiting as long as you are? Why 2028? Is that something that you could potentially do earlier?
No, that's not something we can do earlier, and actually that's quite early. You might remember that we were at rate 4 during COVID, and we have started to ramp up from rate 4 to rate 5 this year and to the rate 10 in 2026. So that's a quite steep ramp up already. We have assessed the readiness of the supply chain to go beyond the rate 10, and we've come with a successful outcome of this assessment and with the possibility to go to rate 12 by 2028. So that is indeed a steep ramp up, and that is freeing up some slots between 26 and 28, and obviously more capacity beyond 28.
Guillaume, great pleasure to catch up. Thank you for spending some time with us on the program this evening. Guillaume Faury, the CEO of Airbus. Guys, back to you.
All right, great stuff as always. Guy Johnson, thank you so much, as he said, talking there with the Airbus CEO. Some headlines crossing the Bloomberg off of that interview, specifically talking about the supply chain being stretched for some years. And this one certainly caught our attention, that Airbus has no available slots for the A320 family until 2030. So
it's just remarkable.
We talk about this, right? You place these orders, they're in the order stream, if you will, for many years, and it kind of holds up. And you can't just kind of pop in and buy a plane, basically.
Yeah, the CEO also telling Guy just now that Airbus won't take anyone hostage on the Spirit Aero transaction, and that says it's premature to provide a timeline on a Spirit deal. The CEO also saying that a few supplier cases might need financial investment, and that the supply chain, as you mentioned, Carol, will be stretched for some years.
Shares of Airbus just down about 4% off their lows of the session, but that following an update on their business.
Keep that in mind when you're ordering that A320.
I will.
You're not going to get it until 2030, okay?
Well, and if you work for Chipotle and you're ordering
nice transition.
You want
a burrito bowl.
You want chicken in your meals? You're not going to get it.
Here's why. Chipotle telling its employees.
If you work there.
If you work there, yeah.
Which I thought was actually kind of nice, that when you work there, you can eat there.
It makes sense. It told its employees last week not to include chicken in their own meals because surging customer demand crimped supply, but the chain now says its workers can go back to ordering freely. I mean, it makes sense that you want to save this stuff for the customers.
It's
I can think
very
of examples
popular,
of
right?
restaurant owners telling employees, hey, when you come in the morning, please don't park in spots in the parking lot, park somewhere else, so then the customers will have those parking spots later. Same kind of thing.
Yeah. Well, listen, people are doing things to protect their business, you know, whether you're at a Chipotle or whether you're going to Venice, which is a story we have to bring in that you brought to our attention, John. What's going on in Venice?
This is kind of like congestion pricing for like people, for pedestrians. So, I mean, Venice is... It's a destination for everybody.
Right.
It's the most beautiful city, one of, in the world. Carol's never been there, so she doesn't know. But anyway, they're going to charge you now as a tourist to come into the city. I guess you're going to have to wear like an Easy Pass on your head. Under an Easy Pass reader.
It's interesting, right?
It's not really.
They
I
say
thought that was funny, John.
Well, they
don't
say
worry.
that, I know, I'm trying to get serious. Some of us has to be serious. Somebody does. They're trying to balance the wants and needs of tourists and residents, right? So the crowds and so on and so forth. So it is a form of congestion pricing.
Absolutely. So visitors who don't live, work, or study in Venice are going to have to start paying a €5, it's about $5.34 fee on Thursday for a total of 29 select days, mostly weekends, until mid-July from 8:30 to 4. Those who stay in hotels or registered accommodation overnight won't have to pay, according to the mayor of Venice.
Access payment.
I don't know how, well, yeah, it's just like, are they going to have like gates where you walk through and like little turnstiles?
It's a QR code to access the city of Venice.
The idea of over-tourism is nothing new in popular destinations, but the way that they're dealing with this is certainly something.
But then it raises concerns of like, you know, I'm being tracked right now when I go to, for maybe some nefarious purpose.
John,
for the gelato
John,
you can buy in Venice?
Just the name John Tucker, people have been tracking you for years. I'm just going to point it out. Interesting story. You know, that, by the way, Venice back in 2021, they banned large cruise ships from docking to limit the number of visitors. So they've been on a mission. All right, chicken and Venice. Who would have thought we would have put that together?
Hey, it worked. You can do it, Carol.
Yes, indeed. Hey, for those of you watching on TV, the close is coming up next. Chipotle, by the way, we're going to hear from the CEO, Brian Niccol. And we're going to continue to count you down to Microsoft and Alphabet earnings, folks. This is Bloomberg Business Week, and this is Bloomberg.
Live from Studio 2 here at Bloomberg's headquarters in New York, I'm Sonali Bassett.
And I'm Gina Martin-Adams. We're kicking you off to the closing bell here in the U.S. Let's get a check on where markets stand. As you can see, the S&P 500 and the NASDAQ, not so bad. We're clawing our way back from those lows earlier today when the GDP report certainly took out stocks. Treasury is certainly selling off quite a lot, and the dollar not doing much. Something abnormal with the Treasury selling off and the dollar not doing much, as stocks are really where all the action is as we're going into earnings. Sonali?
We're looking at those treasuries selling off. As you've been saying, we have the two-year yields hanging out just under 5%, and today's GDP and inflation numbers fueling stagflation jitters, leaving investors with even more uncertainty to the path of Federal Reserve policy. And speaking of the Fed, Chicago Fed Austin Goolsbee saying in an interview that the central bank has to recalibrate after the latest string of higher than hoped for inflation data. Traders today paring back expectations for a rate cut, now fully pricing in the first cut in December. But there's big tech here in focus. The stakes are high for Microsoft and Alphabet results after the bell today. Those results coming just a day after Meta revealed it will spend billions more dollars than expected this year, and it's been triggering, Gina, a stock sell-off.
Let's kick things off on the tech earnings expectations with Stuart Kaiser, head of equity trading strategy over at Citi. Stuart, tell us, where are we in the cycle right now? Because clearly the tech stocks have been struggling a little bit. We got that news yesterday. Meta beat expectations, and yet the outlook wasn't as good as investors were expecting. What are you doing in your equity portfolio, and how does that relate to where we are in the cycle?
I mean, I think you hit on the key point here, which is the results haven't been that bad, but you need to separate that from what the stock price reaction has been. And clearly a lot of these companies that have put up decent numbers, but either guided a little soft or maybe not hit on a few kind of key metrics have traded off pretty hard. And I think that says if you're overweight these tech stocks, you need to be a little careful. We've been recommending using, triple Q's puts to kind of hedge that long tech portfolio as we go into earnings, just for this reason. Not that we're negative on the fundamentals, but the crowding and the positioning does seem pretty full right now.
Right.
Speaking of, there's some volatility you're seeing in the names. You see it in Meta today. How much more downside risk is there now that we're getting some of these numbers out of the gate?
I mean, downside to the market, I think there's a little bit. I think, as Gina mentioned earlier, the GDP print this morning probably opened up a little more space to the downside than we thought you would had. Our view coming into earnings was a combination of strong GDP and strong EPS growth, set a very high floor for U.S. equity markets. Getting higher inflation and lower growth than you would have wanted probably opens up a little more space there. And as you have key stocks, whether that's Meta, whether it's ASML, whether it's Taiwan Semi, whether it's Netflix, some of these key high-flying stocks kind of coming under pressure, I think it hurts your risk reward, and it probably opens up a little more space to the downside than I would have thought we had a couple days ago.
What has surprised you so far in this earnings season? I know it's early. You were sort of positioned for a rockier period given expectations in tech. Anything outside of tech that's been interesting or that we should keep an eye on?
Yeah, I mean, look, tech has gotten all the focus. I think, the financials earnings, I think, to start were interesting because we did start to see a little bit of that deal calendar coming back. And obviously, Goldman and Morgan Stanley responded a little bit more positively to that. So that's a positive if you're looking for the rest of the year. But, there's three themes that we were really looking for in earnings. One was
à toutes les personnes qui passent leur temps à réfléchir à leur prochain job ou à leur reconversion sans trop savoir quoi faire, arrêtez de scroller, j'ai quelque chose à vous dire.
The third topic is going to be later in the quarter. What do retailers say? Is there any evidence of this really strong consumer spending pattern, kind of seeing some weakness? So, the biggest surprise, I guess, is going to be we came in pretty bullishly positioned, pretty small implied moves, options set up very positive, stocks that are putting up what I would consider decent numbers, missing on sort of a KPI or something, or really getting hurt. So that would probably be the number one, surprise so far.
It's interesting. Speaking of outside of technology, you look at some of the best sectors this year. You have the energy sector in the S&P 500 still up more than 15% on the year. Some of these stocks are still reporting pretty gangbusters profits and seeing a sell-off after that too. I mean, are these sectors overbought? And if that's the case, then what does it mean for the S&P?
Yeah, I mean, overall tough. I think stock basis, you probably need to go, about that. From an S&P level, we actually triggered what we would call oversold the middle of last week on the sell-off. So the equity market itself doesn't feel overbought, but I think there are pockets that are. We've seen a tremendous amount of demand for energy stocks, for copper, and sort of that commodities exposure. So that stuff's probably gotten a little bit more ahead of itself than it was last quarter. I would have argued coming in that positioning in tech actually looks a little bit less overbought than it did last quarter. So look, when you have valuation where it is, we think the ERP is probably in its 15th percentile in the last 30 years. I mean, you're at an extended valuation spot right now. So any blemishes are going to be treated, I think, more harshly in that situation than they otherwise would have. Our view on valuation, that's potential energy, not kinetic energy. What releases potential energy? In this case, it seems to be good but not great results, essentially.
I'm curious how you're incorporating movements in the bond market into your strategies. Clearly, the bond market has been a new animal in the post-pandemic cycle relative to the pre-pandemic cycle. How do you think about that in the midst of earnings season when you have these really big bond market moves? How do you incorporate that on a day-to-day?
It's a big, important part of the macro landscape from our perspective. We tend to focus more on the size of the moves and the volatility in the bond market than necessarily the absolute level. Like, even if we got to 5%, and that's not a forecast, but even at those levels, if bond market volatility sort of pegged itself there, I think equities can do just fine in that environment. What's tricky here is we went from nearly 5% down to 4%, and now we're kind of on our way back up to 5%. So I think we're considering that two ways. One is the velocity of the move, and then two, it's which stocks have the most sensitivity to that. Most of the equity market is basically long growth and has a negative impact for higher yield. So it eats into your valuation, but again, for us, it's much more about volatility in the bond market than it is about the absolute level.
I think it's worth kind of doubling down here on what gets impacted if you still have the 2-year closer to 5%, and for how long? At what point does that pain start to multiply?
It's a great question. I mean, it's funny because people have been calling for this credit event now for a while, right? But the fact is, most of corporate America is actually pretty well situated from a credit perspective. Even the companies that need to refi don't need to refi now because people were smart enough to lock stuff in. So I think my view is if you're higher for longer, yes, eventually that starts to get into your weaker credit type stocks. But for most of the first quarter, you were higher because of better growth. And if you're getting better growth and that's pushing yields higher, I think equity markets can deal with that just fine. What's really been disruptive the last 4 to 6 weeks is you've had higher yields, and that's becoming from the inflationary side. So look, if we get into the second half of next year and we're still pushing out cuts, then yeah, people are going to take a second look. But we actually had a lot of trouble finding companies that actually have to refi in the next 24 months. So it's one of these things, yes, it's an issue, but it's hard to sort of identify the specific stocks that might be impacted.
Sticking with the macro, how are you incorporating currency and sort of the divergences that we see globally? We lived in a world for so long where everybody moved together, and now it seems to be quite divergent activity between the U.S., China, Europe, Canada, name your country. Mm-hmm. How do you incorporate currency? Is that a part of your thought process?
It is. I think my experience has generally been you need the dollar to move pretty big and then stay persistently at that level to really get into earnings, right? So this is, a lot of these companies hedge their currency risk on a waterfall fashion, right? So you need big moves that are persistent. I think the question here is if you start to get currency volatility, and that's because you're either getting growth divergence or central bank policy divergence, well, now you're talking about risk sentiment, and that can kind of get into your valuation. So similar to rates, like if the dollar is grinding one way or the other, a little bit less concerned. But if we do start to see central bank policy divergence, and that gets into your risk, and I think that's what we'd be the most concerned about. Gold is a perfect example of this. Obviously, gold has been moving almost of its own volition, and I think equity folks are thinking, I don't really understand what's going on over there. Right. Maybe I need to be more careful just because I don't understand. And I almost put the dollar in the same category right now.
Fair. Sure, we have to leave it there. Thanks for joining us on what's been a tough tape and a very busy day of earnings and a very busy week ahead still. Stuart Kaiser, head of equity trading over at Citigroup. Coming up, Chipotle's strong earnings beat, sending shares surging today, extending a nearly 6-month rally that's seen the stock climb nearly 66%. And the CEO, Brian Niccol, joins us to discuss what's fueling the growth. Plus, Hertz driving in the opposite direction, shares hitting an all-time low after reporting a loss that was nearly 3 times worse than analysts expected. And it's our stock of the hour. And Southwest is considering ditching a classic hallmark of its business model. We'll discuss the airline's potential move as it grapples with slowing growth. All that and more coming up. This is The Close on Bloomberg. Stick with us.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA. A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Shares of Southwest are sliding today, and that's as the airline ends service at 4 airports and offers voluntary leaves to address challenges that are stemming in part from reduced deliverings of Boeing planes. Bloomberg Intelligence senior analyst George Ferguson joins us on the airlines, all over them really this week. George, when you think about the problems that Southwest are facing today, exiting airports, how do you feel about the changes being made?
Yeah, so I mean, when I think about Southwest, I think, frankly, they've been trying to add too much capacity to the marketplace. And so, look, as much as they need Boeing aircraft because they're larger and the increase in pay they gave to their pilots' unions, those larger aircraft allow them to spread the cost of that pilot over more people in the airplane, help them lower their costs. So for sure, the lack of getting airplanes is really making it difficult for them to drive down costs and improve profitability. But this is an airline that was looking to grow its schedules at 6% in an economy that's grown maybe 2% since last year. I think really the post-pandemic bounce where everyone had to go away on summer vacation, fly somewhere on summer vacation is over. So that extreme demand, I think, is fading. And I think so, fares just aren't rising anymore. They were flat at Southwest. They were down at American today. And so I think part of what Southwest really needs is less capacity, less flying, and that's why they're cutting back these cities.
Is there a read-through from Southwest, George, to the rest of the industry? You mentioned American as another specific example, but when you're looking across the entire airlines industry, is this something we need to look for across the space?
It is, right? And so I think you saw it in JetBlue's earnings. I think the more your airline is focused on the domestic business and the basic economy seat, the more challenges you have. There's just too much of that capacity in the marketplace, we think, right? And that means that that's a commodity and you're going to have to lower prices to fill airplanes. To the extent you're in premium seating, you can provide, any kind of sort of upgrades, a better meal, more space. And those are the Deltas, those are the Uniteds. You're going to see better yield development, which is the price paid per mile flown, and that's what we've seen. American is one of the full-service carriers that actually caters more to the economy, seating, and a little more of the interior of the country. And I think that's why they had more of their problems today.
It's interesting. You have Southwest saying that the restructuring steps that they're taking so far could contribute $1 billion to $1.5 billion to the pre-tax profits this year, but the market doesn't seem to be biting on the plan. Why is that?
Well, again, I think we're seeing some softness in the marketplace, and so I'm not sure, the market really believes that Southwest can get fares to rise to the level they need, and it's going to be hard for them to cut expenses because, like I said, they're just not going to get all the deliveries of the Boeing Maxes, and so they're going to have a hard time, sort of spreading those costs over more seats. So they're in a bit of a rough patch here because they can't really reduce expenses well, and revenue isn't going to cooperate for them, I don't think.
Speaking of those expenses, I'm curious how the airlines are now positioned for higher fuel costs, higher oil costs. We've seen the cost of oil obviously accelerating pretty rapidly so far this year. How are they positioned going into the second, third quarter, and where might we see some surprises on the input cost side?
Yeah, so I think that if fuel costs keep going up, and frankly, even if they just stay here, they're going to be higher year over year, and that's going to create a real challenge for the airlines, right? So they don't hedge. Most of them don't hedge. I mean, you get a bit of hedging at JetBlue and Alaska, but the core, and I will say actually Southwest does hedge as well. So those airlines could potentially fare a bit better as fuel prices rise, but most of them don't. And so that'll be a challenge. And two, again, we think the basic economy seats are probably in excess, and so therefore pricing a little bit soft. It'll be really hard to push through that increased cost to that basic economy customer. Now, if you're a United and you're at Delta, and the front of the airplane is really demanding summer vacation travel no matter the cost, you could probably push it through to them, and to the extent business continues to flow back for those big full-service airlines, you'll push through to them the increased costs, and they'll be able to manage it. But the more you're in the basic economy world, it's going to be really hard to do.
You saw Southwest really address significant challenges in part from the reduced deliveries of these Boeing planes. Where else can we see the Boeing challenge start to ripple into the airline industry?
Well, so United should have it, but I'd say, United used to be less focused on their domestic business, and they used to use smaller gauge airplanes on it. So they've been increasing size, which has been helping them, and they've been sort of bridging some of that gap between them and Delta in fares. So you should see it there, but you don't because, again, of this change going on at United. Alaska's another one I get concerned about. They're a very big Boeing shop taking a bunch of deliveries. Alaska showed some pretty good results this quarter, and it was driven by what they called a nice return in California business travel. And we saw Southwest tell us the same thing, and so that tells me that Alaska might be getting a bit of a bump from maybe some better West Coast trends. Alaska does have some premium seating too that helps, but those are the ones I worry about the most. Right? There'll be Southwest, there'll be Alaska, there'll be United are the big Boeing customers here in North America.
George, we have to leave it there. Thank you so much for your time and for all your analysis this week on a very busy earnings week. Also for the airlines, of course. That is George Ferguson of Bloomberg Intelligence. And coming up next, we're going to talk about tech because artificial intelligence and cloud infrastructure are top of mind over at Microsoft. We'll preview what to expect for the third quarter report. This is The Close on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
top calls, a look at some of the big movers on the back of analyst recommendations, starting with Monster Beverage. Truist cutting the energy drink company 2 notches from buy to sell. Analyst Bill Chappell calls Monster a great company, but with limited reach. He questions its ability to tap into new customers for sales and growth. He also says there's no reason why it should continue to hold a super premium valuation multiple. This is Monster's only sell rating. JP Morgan also downgraded the stock this morning, and shares are moving down more than 2.2%. And Deckers Outdoor, next in line, the owner of the footwear brands Hoka and UGG. A downgrade to neutral from buy at Bank of America. Near-term trends at Deckers are fine, but the analyst cautious that a softer than expected margin outlook could temper the pace of upwards earnings revisions. Therefore, he sees better opportunities elsewhere within his coverage. Shares also down more than 5% on that name. Finally, UPS upgraded to buy from hold at HSBC. Price target raised to $170, up from $150. The analyst expects the shipping and logistics company to shift its focus on volumes and margin recovery. This, coupled with its UPS Postal Service contract, could restore confidence in its 2026 guidance, and shares now moving up about 0.2%. And those are some of our top calls. And we're also less than an hour away from Microsoft's third quarter report. Revenue expected to increase 15% in the quarter, mostly driven by its Azure cloud computing unit. Joining us now for more on this is Truist analyst Joel Fishbein with a buy rating on Microsoft. Do you still see risk going into the earnings today, given the sentiment we see around the big tech names and any signs of weakness?
The only, thank you for having me, first of all, but the only risk we really see is macro related. Obviously, we can't control what happens with interest rates and the economy and the markets moving on this economy. But we think that Microsoft is amazingly positioned here to capitalize on this big trend that you brought up in your preamble, which was AI. And frankly, there's no better positioned company there. And we think those numbers coming out of Microsoft are going to be very positive. We've got a lot of data points. We've done a proprietary survey that says 80% of the customers we surveyed are going to increase their spend with Microsoft. So we think Microsoft is well positioned to come out of this earnings and several others in a very positive light.
Joel, can you put Microsoft in the context of the overall software industry? You mentioned that it is something of an outlier. It has unique tailwinds relative to the rest of software. What are you looking for across the space? In addition to sort of Microsoft's nuanced approach, what are we seeing in software? What should we look for in this earnings season?
It's great. It's a great question. You know, we think that obviously AI has been overhyped. There's been billions of dollars been spent in AI, from infrastructure to applications. And if you think about Microsoft's unique positioning, they have over 1 billion users of Microsoft Office. They have a massive cloud computing network, and not unlike Google and Amazon and also Oracle building one as well. But we are now seeing them move from people piloting into actual production, and companies like Walmart and Mercedes are using AI, Azure as a service, which will be driving the numbers not only here in the near term and the long term. And I think that puts them in a very unique position relative to a lot of the other companies. And this is one of the names in our space that we're actually seeing monetization, people actually making money on AI, and we think that could drive the growth rate higher. We think the Azure growth, the bogey here is 28%. We think it'll likely be higher. The street's at 15% overall top line growth. We think they'll probably do closer to 16 to 17, driven by this AI trend, and we think that'll continue. We think we're in the early stages, and that'll continue for some time.
Joel, we asked you about the downside risk, but what about the upside? If you think about where they have the potential to really expand on expectations currently set out by the street, where do you think that they could provide a little more color?
So I think that's going to be the real question here. How much do they want to disclose from a competitive positioning? They talked about AI contributing to their Azure growth, going from 1% 3 quarters ago to 6% right now. We think they're on the trajectory of it being closer to 8 to 9%. Do they disclose that number? Number one. Number two is, do they disclose how many AI Copilot users they actually have? Again, from a competitive perspective, they probably don't want to, but they're really going to get pushed on a lot of color about that. Again, externally, we're hearing demand is very, very strong, and we're moving from trial and piloting into real production. And people were talking about massive cost savings by enabling this. So those are some of the key factors that I think we're looking for from Microsoft, and they'll be pressured to give a lot of color around them.
Talk a little bit to us about their capital deployment. What is Microsoft doing with their cash at this point in time? How does that differ from the rest of the software and then the rest of tech?
So the first thing they've been doing is they've been deploying it towards AI investments. You've probably seen massive amounts of investments. The latest one was in the Middle East, building out data centers there. They've, I think they've spread the love around in terms of investments here. They've done some what I call acqui-hires, where they're going to some of these AI companies and hiring engineers. That's number one. I think they'll continue to buy back stock, offset dilution, and I think that you'll continue to see the small dividend going forward. They do need to, this is a capital intensive business, building out these data centers, so you'll think a majority of the cash investment will go towards that.
We got to leave it there. That's thanks to Joel Fishbein over at Truist. And coming up next, we're going to talk about Chipotle sizzling hot quarterly results and a pickup in traffic. That's all up next. Conversation with the CEO. This is The Close on Bloomberg.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? How do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
It meant that you always look different because you were the first woman, you're the first brown person, the first Asian, the first Indian, the first person of color to lead a global luxury brand. You're always the first, you're always underestimated. People don't know exactly what to expect. They're suspicious of what your agenda might be.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
For our television and radio audiences, I'm happy to welcome now Brian Niccol, the CEO of Chipotle, who, of course, has just announced that the full-year outlook over at Chipotle would be boosted for the year because there is more growth there than at other fast casual rivals in this space here. Brian, what's going differently for you than perhaps a lot of the industry? What is driving people into the stores?
Yeah, well, great to be with you guys. And look, I think the purpose of Chipotle has always been food with integrity, using classic culinary techniques so that we give people delicious, nutritious food. And, the thing that I think we've just done even better of late is bring that experience to people in a fast way. So, one of the things that also makes our brand really special is the customization that you can get with all these great ingredients. And so we've been working hard to ensure we're staffed, we're trained, we're deployed, so that our team members can give people exactly the burrito or bowl experience that they want at a pretty meaningful speed so that people can get on with their day. So I think that's what you're seeing is the power of great food, great culinary, great people, and now also some great operations around throughput.
Can you talk to us a little bit, Brian, about the general state of the consumer? I think this stands out as a very strong success story, but also in the midst of a lot of skepticism with respect to how much the consumer can continue to spend and the general health of the consumer. What do you see from your consumer? Is it Chipotle specific, or do you generally see a very strong consumer out there?
Yeah, look, when we do the research on a broad scale basis, we definitely see that consumers are feeling a little bit of pressure on the economic side of things, right? Gas prices are elevated. They've been dealing with inflation for a while. Fortunately, the wage market has been strong and unemployment has been really low. So the good news is jobs are there, wages are there, but they are feeling pinched on, kind of their budgets. As it relates specifically to Chipotle, fortunately for us, the feedback we get is the value proposition has never been stronger. So if they're being more choiceful in how they're going to choose their $10 or $15 on a meal away from home, what we continue to hear is we're one of the great solutions for that type of outlay of cash. And so, that's why we're so dedicated to having great ingredients, great culinary, and then obviously giving people the customization that they want so they can get the food at the speed that they want to. So I think that is the thing that's separating us right now is our ability to provide this great culinary, great ingredients at what are pretty reasonable prices.
It's interesting because some of your products are so popular that not just the earnings today are grabbing a lot of attention. It's this idea of chicken and the chicken shortages really being faced. We had reported that you told staff, or recommended rather, that they stop eating the chicken given the popularity of some of your chicken items on your menu. How has this been perceived by employees? There has been some pushback on the idea of itself, and do you have to change anything in terms of the way you handle the product?
No, I think this is a story that's looking for a headline. What actually happened is the supply got really tight. We asked all our employees, including myself, to pitch in for a week to maybe try something else on our menu. The good news is we're through that pinch. There's no challenges on our chicken supply. Actually, our supply team's done a fabulous job of securing supply to what has been really tremendous demand. So, look, the good news is our employees were happy to pitch in. I guess there were maybe some employees that didn't want to pitch in on this one. But in the end, we came together, did what we needed to do, and we're going to continue to focus on giving people great experiences with our product, and that includes chicken.
It's interesting because you guys have been very fast to pivot around a lot of things here. I'm really curious around other potential ways you react to the consumer. You had mentioned kind of the general state so far, but do you think that the consumer would be vulnerable to any future price hikes? Do you think that the price hikes already have been put on products are as far as you can go?
Look, I don't know the answer to that for everybody. The good news for Chipotle is we definitely believe we still have some additional pricing power if we needed to take pricing in the future. Our hope always is that we can hold our pricing because we want to protect our value proposition always. And I think, frankly, it's one of our competitive advantages, or really positions of strength, is just the strength of the brand because of our unique commitment to ingredients and the speed at which we can get people these customized meals. So, look, I definitely think the consumer is feeling pressure, all right? We've had inflation for the last couple of years. In some cases, things are up 20, 30% from where they were just not that long ago. And now here we are, hopefully with inflation starting to moderate, but still things are well elevated from where they were a couple of years ago. And I think that's what positions us so uniquely in this space is, at the end of the day, you can still get a really meaningful bowl or burrito from Chipotle for, around $10, if you choose not to have chips and guac or drink and stuff. So, look, I would suggest everybody look hard at their value proposition and ensure people feel great about what they're getting for what they pay. And if that plays out, you'll be rewarded with business. I think that's what we're seeing happen at Chipotle.
Let's talk a little bit more about those embedded costs and just the general sort of embedded inflationary costs and how you're managing through that inflation. I know that Chipotle has several automation projects underway. Maybe talk to us about where your automation priorities are and how much that might offset the margin pressures from steadier inflation.
Yeah, so thanks for asking about this. Obviously, we set out to figure out what are ways we can be more productive in the restaurants. And specifically, we started with asking our employees, what are the pinch points? What are the things that are most challenging to do? And one of those things that came up was cutting, coring, and scooping avocados every morning to make our guacamole. And so we've created a new robotic or cobotic device that will cut, core, and scoop the avocado. We still have to hand mash it, and we still have to, add the cilantro, lime, jalapenos, and onions and stuff. But, it gets rid of some of the harder parts of making guacamole every morning. And that's just one example of many other things we're looking at. We got feedback that frying the chips is a difficult task. So we experimented with a robotic arm to fry the chips. That one hasn't worked out, so we're going back to the drawing boards. But the good news is the learning from the robotic arm for frying chips informed what we did on designing what we call Autocado. And then other places that we're looking to build innovation is on our digital make line. Is there a way for us to help our employees build bowls and burritos on that line so that with the one or two people working on the line, they're capable of producing even more burritos and bowls? So other things too, like AI, machine learning to help us in our rewards program, our forecasting, our supply chain. So I'm really optimistic about the innovation that we've got coming down the pike. Obviously, we have to take it through our stage gate process, validate it, ensure that it really plays out the way we want. But I think we're hunting in the right places that'll make the job better, protect the experience for our customer, and provide no compromise on the culinary.
It's interesting. Speaking of inflation, curious about the California $20 an hour minimum wage for fast food workers. Since this has happened here, curious, Brian, about your view on what else would be impacted with that rise in minimum wage for workers here. How do you think about how that fits into your broader cost picture and whether you need to make changes elsewhere?
Yeah, I mean, look, obviously, we moved wages accordingly, and then, I'm sure you're familiar with this, but that creates compression for wages throughout the business, meaning managers and apprentices and people that have more tenure at the crew level. So we adjusted all those wages accordingly, and we did take a price increase in California to offset the wage inflation that we're dealing with, which is close to 20% wage inflation. And what I'm happy to say is, we didn't have to change anything else. We're not cutting corners on our food. We're not cutting corners on portions. We're not cutting corners on the speed at which we provide our service. We're committed to giving people the Chipotle experience they know and love with the culinary that they know and love. And, obviously, we had to raise prices a little bit, but, the reality is it's more expensive to do business in California, and, we adjust accordingly.
Brian, we thank you so much for your time. We should say Chipotle shares actually today hitting a record off the heels of those results as well. That is Brian Niccol, the CEO of Chipotle Mexican Grill. We're going to stick with that last thing we were talking about, that California wage hike that we've seen. Bloomberg Economics says that it could also raise the risk that the Federal Reserve delays its first rate cut. Joining us for more context is Anna Wong. She is Bloomberg Economics chief economist. Very curious about how you see this wage hike really impacting the broader economy. Of course, California being a whale in the room here when you think about how many people live there in the United States.
Yeah, so, California employed about 12% of the total national employment, and the number of workers that are directly affected by this fast food minimum wage hike is about 500,000, and just those 500,000 workers seeing 20% increase in wages would boost the employment cost index, which is a wage measure that the Fed pays a lot of attention to. It would boost it by 0.1 percentage point. And add to that, as Brian just said, not only are the fast food workers seeing 20% hike, but they need to raise the wages for managers and a lot of other related jobs. That could boost the ECI by a total of 0.2 percentage point. And the Fed is getting these numbers on the second day of their July FOMC meeting. So that means that it could be that when they looked at the employment cost index, they would go like maybe they couldn't do the cut in July. And we also think that if they don't cut in July, then they probably miss the window for cutting, because thereafter unfavorable seasonal patterns, base effects would cause the 12-month change in inflation to drift up.
Anna Wong of Bloomberg Economics, we thank you so much for keeping an eye on something that is under the surface. Perhaps not a lot of people had noticed how that would be a bigger impact here. Now, coming up, we're going to talk about shares of Hertz now hitting an all-time low after the company reported a loss that was nearly 3 times worse than analysts expected. Tons of ripple effects. It's our stock of the hour up next. Stick with us. This is The Close on Bloomberg.
Total money market fund assets rose by $9.13 billion to $5.98 trillion for the week ended April 24th.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Now for today's Stock of the Hour, shares of Hertz hitting an all-time low, and Abigail Doolittle joins to explain.
Yeah, and this is a total mess. So they put up a loss of $1.28 per share. That's almost 3 times worse than what they were expected to do. But they put up $2.1 billion in revenue, which actually beats. That speaks to a margin problem, problems with costs, and really having to do with their pricey EVs. They have this huge inventory of Teslas. Now, ironically, the huge inventory of Teslas, that's because of their biggest owner, Knighthead Capital, asked them to buy these EVs a couple of years ago, thinking the values would go up, but the values have declined. So now they're taking big depreciation charges to write them down. In addition, they've closed locations, collision costs an issue, revenue per car fell. So lots of issues here. But the new CEO, Gil West, he came from the former GM Robotaxi, the head there. He's an operations geek. He's saying he's going to turn it around. He's determined to get it right.
Still a lot more for him ahead and more for us ahead as well on the close. Stick with us. More markets into the close. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The top names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges. Britain's next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and
Markets on close imbalance, 320 million to the sell side.
Every Friday, right here
This is the countdown to the close. I'm Shonali Bassick alongside Gina Martin-Adams. And Gina, we are looking at a market that has been having a bit of a tough day. Pretty remarkable. If you look at it, the S&P 500 still down after some
So keep in mind now, in 10 minutes' time, at the cash equity close today, top of the hour, do you see earnings season continue? Alphabet printing Q1 2024 earnings, estimated EPS of $1.53, estimated revenue 66.1 billion dollars. Same time, Intel are due to print their Q1 earnings too, estimated EPS of 13 cents, and an estimated revenue of $12.7 billion.
GDP, then what's really going on here? I thought at the beginning of the day it was really about GDP. It was really about earning. It was really about what's going on in the economy. But I do think the market is a little bit nervous. Will these tech stocks really put up the earnings numbers that we're hoping for, particularly after Meta sort of disappointed with an outlook that wasn't quite what investors were counting on?
Biggest moments of the day still after the bell. Now, earlier today, we spoke with Stuart Kaiser of Citigroup, and we asked about the increased downside risk in equities after today's GDP numbers.
The GDP print this morning probably opened up a little more space to the downside than we thought you would have. You know, our view coming into earnings was a combination of strong GDP and strong EPS growth, set a very high floor for U.S. equity markets. You know, getting higher inflation and lower growth than you would have wanted probably opens up a little more space there.
For more market analysis, let's welcome Leo Kelly. He's founder and CEO of Verdance Capital Advisors. You know, this idea of downside risk, I think, is interesting, particularly because we did see some, let's say, brutal selling in the last couple of weeks. We did have that optimism come back this week, but at what point do you think the selling is over?
I think the selling's over when we get through what I would call the inflation bear market. This is all a continuation of a 2-year plus time period from 2022 when inflation really started heating up and bond yields started to rise. So until we settle this, until we know how this is going to end, I think we see continued volatility at an elevated pace.
Tell us about what you do with sectors. If you're worried about inflation, you're worried about volatility continuing, tech has done very, very well over the course of the last year or so, despite the concerns about inflation. Would you stick in tech, or do you move to other sectors that are maybe a little bit more inflation sensitive?
Yeah, I think you have to be very careful with tech here, specifically with the handful of names have gone to astronomical levels. Now, they've corrected a little bit, but the valuations are still high. The answer to your question is you have to mine valuation. I think the market started to get overly optimistic about these 6 rate cuts, which for the life of me, I never understood how they came up with 6 rate cuts, let alone even 1 rate cut now seems to be a question. And what we know about technology is technology does better in lower rate environments where capital is plentiful, where people are running to risk assets. That's when high valuation assets do well. So our thought is the risk is higher for inflation to continue. Remember, the Fed has to make a decision here. Either take the economy to the brink of or into recession to fix inflation, or just stay off of recession and deal with inflation never really hitting target and continuing to go higher. That's not the best environment for long bonds. It's not the best environment for tech. So I do think you have to be active here. Financials, small cap stocks. I think the international markets look interesting. Why those markets? It really doesn't have to do with the Fed. It has to do with valuation being significantly cheaper than these top names that everybody's fallen in love with in the last 18 months.
I'm interested in your view here outside of the United States because, Leo, there's still this strong dollar dynamic, and you're seeing it not only hurt other countries, you're also seeing it really weigh on some of the multinationals. Do you think that dynamic continues and can continue to put a pinch in some of the expectations investors had coming into this year?
Well, again, I think international stocks, despite the dollar strength, international stocks have done quite well here over the last year or so. They're holding
So seeing reports
well.
that the US and allies want to cut chip-related China exports amid Huawei alarm.
There's a lot of risk in Asia with what's been happening with China. The markets outside of that still, to us, look to be opportunistic. I think you have to be very patient. They're long-term plays. You get nice dividends in some of these markets. The valuations
So this is
are
the
lower,
Financial Times
and so I
reporting.
think there's
US is
still
pushing
opportunity
allies
there.
in Europe and
Remember,
Asia to
what the
tighten
US
restrictions on
did here
exports of chips, chip-related
increasing
technology,
money supply
and
by
tools to China
40%
amid
2
rising
years.
concerns
That's
about
third
Huawei's
world country
development
stuff.
of advanced
That happened all over
semiconductors.
the world. So really what we have is water rising all boats up and down, and I think we'll continue that pace.
Talk to us a bit, Leo, about how you balance your portfolio of equities and bonds in an environment where inflation is more volatile, more pervasive, more concerning at large, and stock prices and bond yields are positively correlated.
So we're just less than 5 minutes away now to the top of the hour. Cash equity close and earnings from Alphabet and Intel. Alphabet are printing Q1 2024. Estimated EPS is seen at $1.53, with an estimated revenue of $66.1 billion. Intel also printing Q1 earnings, estimated EPS of 13 cents, and an estimated revenue of $12.7 billion. Slated to print after this at 4:05 p.m. Eastern Time is Microsoft. They're printing Q3 2024 earnings with an estimated EPS of $2.83 and an estimated revenue of $60.9 billion.
And some of these growth stocks going down. We've moved money into value-oriented stocks with dividends, aka an income replacement. We're keeping our duration in our bond portfolios low. In other words, buy short bonds, you get a higher yield and less risk. And we really are interested in the private equity markets. Specifically, we like private credit. We've allocated capital to private credit. It's a good place to be. Yields are high. It's not as susceptible to movement with the bond yields in the public markets. And so I think that's a great place to put money. I will say this, though. You have to be incredibly discerning when you go into the private markets. You need to understand or have a manager that understands credit quality and is as good as that as they are at reading a balance sheet.
Leo, we have to leave it there. That is Leo Kelly, founder and CEO of Verdance Capital Advisors, certainly taking us all across the market, Gina. There's certainly a lot going on in almost every asset class you look at today.
Yeah, and it is a big challenge. I do think that that is the biggest challenge for the broader investor classes. What do you do in an environment like this, where we sat in an environment for 20 years where stock prices and bond yields were negatively correlated? So there was an offset. Anytime you had some weakness in equities, you had bond strength. That has not been the case in the post-pandemic world, and that's really disruptive for asset allocators and managers of capital. I do think it also feeds through to the equity market, and we've seen that a little bit through the volatility in the sector rotation. It's a very, very challenging climate.
Gina, of course, we are certainly looking at limbo for a lot of investors out there. But now we are moving closer to the closing bell. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Shonali Bazik and Gina Martin-Adams count you down to the closing bell. And here to help us take us beyond the bell with a global simulcast, we're joined now by Carol Masser and Tim Stenovec, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the crucial moments of the trading day. And certainly, it has been quite the day, Carol.
Yeah, interesting, right? And we're definitely well off our worst levels of the session. Having said that, I look at the S&P 500. You still have more than 300 names to the downside. And folks, if you look at some of the ones that are going to be reporting, Google, it is down right now, just shy of 2%. Microsoft.
So we're shortly expecting earnings prints from Alphabet and Intel. Again, this is due to post at the top of the hour. Keeping our eyes peeled any time from now. And do remember after this as well, about 5 minutes past the top, and Microsoft are due to print as well.
Gina, the S&P 500 down more than 1.6% earlier in the session, now down only half a percentage point.
Yeah, and a nice climb back. And tech is not leading the downdraft, which is interesting considering all the nervousness around tech. This really seems to be related to Meta and a market that was caught off guard by what Meta said regarding their spending and their future growth prospects. It's definitely weighing on the rest of the communications space, putting a lot of pressure on Google after the close, or Alphabet, as the younger folks say. Nonetheless, I do think it's notable that tech stocks are actually in the green now, the tech sector rising, and that's helping the broader S&P 500 claw its way out of this negative territory.
Yeah, it's interesting, and we'll see what today has to bring as well. Just a lot of uncertainty out there as we wait to see what more of the tech giants have to say. We are getting the bells here now down to the close, and we are indeed ending the day again in the red here.
And no signs of earning prints yet.
Really still down on the day, having closed close to 0.5% lower, with even bigger declines here on the Dow Jones Industrial Average, down almost 1%. That NASDAQ 100 now down about 0.6%. Of course, snapping that winning streak we saw earlier in the week.
All right, guys, real quick on some of the movers in today's session. NVIDIA, that stock up about 3.6%. This has to do with what we got from Meta, basically, because as they have saying, we're going to do up our spend, our CapEx. We're doing a lot of things when it comes to AI. So companies that play in the AI space benefited, and that included NVIDIA. It was up about 3.5%. And you also had Supermicro. It was up about 4.3%. Hey, folks, we've got Microsoft, so let's get to it. Crossing the Bloomberg terminal. Third quarter revenue, $61.9 billion, better than what the street was forecasting. That was a
Seeing
forecast
Intel
of
earnings come across now, the
billion.
revenue is a beat slight at $12.72 billion on estimates of $12.71 billion. A data center and AI revenue, $3 billion. Adjusted gross margin at 45.1%, beat on estimates of 44.5%. Mobile eye revenue, $239 million. And they see their Q2 revenue at $12.5 to $13.5 billion, below the prior range, below the prior estimate of $13.63 billion. So a miss on forward guidance revenue from Intel.
Better than forecast, and you've got the stock up almost 5% here in the aftermarket.
Yeah, expectations were for about $61 billion. We're seeing it at about $62 billion for the third quarter. Going to the press release, looking at what Satya Nadella, chairman and CEO of Microsoft, has to say about the quarter. Quote, Microsoft Copilot and Copilot Stack are orchestrating a new era of AI transformation, driving better business outcomes across every role and industry. Shonali.
Now, it's interesting. We do have Intel also now out. You do have adjusted EPS forecasts missing analyst estimates here. The second quarter revenue is estimated to be $12.5 billion to $13.5 billion, and the estimate had been $13.6 billion. A little shy of expectations there, even with
so no signs of Alphabet yet, but seeing Microsoft earnings come through now. EPS is $2.94. So that is a beat on estimates of $2.83. Revenues a beat as well at $61.9 billion on estimates of $60.87 billion. Productivity revenue had to beat at $19.57 billion on estimates of $19.54 billion. Intelligent cloud revenue for Microsoft is also a beat at $26.71 billion on estimates of $26.25 billion. Personal computing revenue a beat at $15.58 billion on estimates of $15.07 billion. So again, beats across the board from Microsoft there, and their shares are gaining over 5%.
Revenue, $80.54 billion, beating estimates of $79.04 billion. First quarter EPS, wow, coming in way above expectations at $1.89 versus estimates of $1.53. We're also seeing first quarter operating income significantly beat expectations, up $25.47 billion versus $22.48 billion. The stock just surging right now, up 8%.
Well, taking a page from, should I say, whose book? Meta's book. The company, the board approving initiation of a cash dividend, declaring a cash dividend of 20 cents a share.
Alphabet earnings will also hit the wires as well. So their EPS is a beat at $1.89 on estimates of $1.53. Revenues a beat at